Welcome to this deep dive, tailored just for you, the learner. Today, we're venturing into a really rich collection of letters, spanning several decades.
Yeah, it's like getting a peek over the shoulder of these, experienced investors and business minds.
Exactly. Watching them navigate all these changing economic times, sharing their thoughts. So your mission, the learner, is basically to soak up knowledge about long-term investing, strategy.
And how to handle market swings without, well, freaking out.
Right. We'll unpack things like intrinsic value, compounding, the importance of good management. Keep an eye out for those aha moments.
Definitely. And starting right back in 1980, it's fascinating how they talked about inflation.
Oh, yeah. What stood out?
Well, it seemed counterintuitive. You had high inflation, like 12%, but businesses might still show, say, 20% return on equity. Looked good on paper.
Okay, yeah, it sounds great.
But for high bracket investors, maybe 50% tax after you factor that in the inflation in,
Uh-oh.
your real capital, your actual purchasing power, could be shrinking, even with those earnings.
Wow. Okay, let's unpack this. So the learner, the key thing here is you can't just glance at the headline returns.
Not at all. Inflation and taxes, they're like these silent thieves.
Yeah, chipping away at your capital, even when the numbers look big, it really makes you appreciate stable prices, doesn't it?
Totally. Lower stated returns might actually leave you better off in real terms.
Now, that same 1980 letter, it also dives into Geico Co.
It does.
Yeah.
Big time. It mentioned their earning power was way, way higher than what they were reporting.
How much higher are we talking?
Potentially, the undistributed part could have been like 40% of Berkshire's entire reported operating earnings.
40%. That's huge.
It is. And the insight there for you, the learner, is look beyond just the reported accounting numbers.
Right. The real economic engine might be, well, much stronger.
Exactly. And what's interesting is the comfort level mentioned with Geico's management keeping those earnings, reinvesting them.
Ah, so not paying it all out as dividends.
Yeah,
More of a long-term growth mindset.
precisely. Prioritizing future growth. And it wasn't just about holding the cash.
What else were they doing?
Buying back their own stock. Geico is repurchasing shares,
Okay, so enhancing shareholder value that way.
dramatically enhancing it, according to the letter. Basically saying, this business is fantastic, hard to copy, and buying our own stock when it's undervalued is a great use of capital for you, the owners.
Makes sense. Now, stepping back to the broader insurance picture in 1980, it wasn't all smooth sailing, was it?
No, definitely not. The letter points out big headwinds for property casualty insurers. Inadequate pricing was a major issue.
So, a tough environment overall.
Very tough. And Berkshire's financial strength, it gave them staying power, more options than others.
Like having that, well, during a drought, as you put it earlier.
Exactly. But, and this is important, the letter emphasizes that even Berkshire wasn't totally immune. Financial strength helps, but...
It doesn't make the industry problems just disappear. Got it.
And national indemnity within Berkshire is mentioned too.
How are they doing?
Exceptionally well, actually. Despite flat volume, their underwriting discipline meant they had really high profit margins.
Discipline sounds like the key word there.
It really was. They even expected volume to decrease the next year, 1981, but the managers wouldn't be penalized for it.
Wow. That really shows a focus on quality over just, quantity or sheer growth.
Absolutely. Long-term value, not just short-term volume targets.
Okay, fast forward a bit to, say, 1982. The letters start talking about the unique nature of insurance supply.
Yeah, this is a key insight. Supply and insurance isn't like a factory with physical limits. It's described as mental capacity.
Mental capacity? How so?
It depends on the willingness of underwriters to actually write policies, their risk appetite, their psychology.
Ah, okay. So it's not just about how much capital is available. It's about whether the people making the decisions want to take on the risk.
Precisely. So even if industry profits are bad, supply might not dry up if underwriters are still willing, maybe just more nervously, to write business.
Interesting. Now, 1982 specifically, Berkshire's own insurance performance took a hit then.
It did, surprisingly. It actually deteriorated more than the industry average that year, despite their strong history.
So even the best aren't immune to cycles.
Exactly. And they were bracing for a poor 1983 as well, expecting only average performance, which meant poor in that climate.
But were there bright spots within Berkshire's insurance crew?
Yes, definitely. The letters specifically call out managers at Cypress and Kansas Fire and Casualty, describe them as simply incapable of being average.
High praise. What made them stand out?
A relentless focus on keeping costs down and providing really great customer service, that drove underwriting profit even when the industry was struggling.
So management quality shining through again. Then 1983 arrives, and Geico has this amazing turnaround.
Remarkable turnaround. While Berkshire's overall insurance results were still lagging, Geico just soared, way better than the industry.
What was the magic formula there?
Two things, really. One, an exceptional business idea, that low-cost model. And two, an absolutely exceptional management team. Jack Byrne, Bill Snyder, Lou Simpson.
Right, the dream team.
They nailed the underwriting discipline, and Lou Simpson's investment management was, well, stellar. It just shows the power of a great business model combined with top-tier execution.
Okay, so looking across more years now, this cyclical nature of insurance pricing keeps coming up, right?
It's a constant theme, described almost like a commodity business.
How so?
Well, when conditions are good, maybe there's a shortage of capacity, prices go up, profits are high.
It was good so far.
But those high profits act like a magnet. They attract new capital, new competitors jump in, existing ones expand.
Leading to overcapacity.
Exactly. Too much supply chasing the same business, and then prices inevitably fall. It's a cycle. Boom and bust, almost.
So high profits in insurance tend to sow the seeds of their own destruction, in a way.
Often, yes. It makes it really hard to sustain exceptional profitability long-term unless you have a real, durable competitive advantage.
Which brings us back to Geico's cost advantage. That moat they established early on.
Precisely. That fundamental edge allowed them to thrive even when the market got hyper-competitive.
And we see their market share grow significantly over time because of it, like 2.5% in 95 to over 7% more recently.
Yeah, and that growth was helped along by spending more on advertising, building the brand, widening that moat even further.
That moat concept, the learner, is so critical in business. A sustainable edge.
Absolutely vital. Now, the letters also talk a lot about float.
Right, the insurance float. Can you break that down simply?
Sure. Basically, insurers collect premiums up front, but they pay out claims later. The money they hold in the meantime. That's the float.
Okay, a pool of capital they get to hold temporarily.
Exactly. And the key thing is the cost of that float. If an insurer's underwriting is profitable, premiums collected are more than claims and expenses paid out. Then the cost of holding that float is actually negative. They're effectively getting paid to hold billions of dollars.
Wow. And Berkshire historically has been very good at achieving that.
Exceptionally good. Often achieving a negative cost of float, which gives them this huge amount of essentially free money to invest. It's a massive advantage.
And underpinning that is this intense focus on disciplined underwriting, right? Described as a religion, Old Testament style.
That phrasing really captures it. It's about rigorous risk evaluation, having the guts to say no to bad business, even if it means lower volume.
Not just chasing premiums.
Not at all. And they're always thinking about the big risks, too, the mega catastrophes, making sure Berkshire has the financial strength to withstand huge, unexpected losses.
That preparedness must be crucial for long-term survival in insurance.
Paramount. You need the discipline day-to-day and the financial fortress for the really bad days.
And the letters mention specific managers who embodied this. People at National Indemnity, Gade Iku General Re.
Yes, names like Phil Leach, Jack Byrne, Bill Snyder, Lou Simpson, later Ajit Jain, Tad Montross. It really highlights that leadership talent is absolutely essential across all these different insurance units.
Their long tenures and consistent results speak volumes.
They really do. It's a testament to Berkshire's decentralized approach, finding great managers and letting them run their businesses. And you see the result in the float growth over decades, just massive.
Though the letters do suggest that kind of growth might slow down now, given the sheer size.
Logically, yes, the base is enormous. But they also suggest a big decline is unlikely soon because of how the contracts are structured. It's sticky.
Okay, let's pivot. The learner. Capital allocation and intrinsic value. These are huge themes.
Central themes, absolutely. And right away, there's this constant distinction between book value and intrinsic value.
Explain that difference again. Book value is?
Book value is the accounting number. Assets minus liabilities on the balance sheet, kind of a historical cost snapshot.
And intrinsic value?
That's the real economic worth. What a business is truly worth based on the cash it can generate over its lifetime, discounted back to today.
And Berkshire's own story illustrates this perfectly.
Yes. Back in the textile days, the book value actually overstated the real value because those assets weren't earning much.
Right. The underlying business was struggling.
But as they bought great businesses insurance, See's Candies, etc., The intrinsic value started to far, far exceed the stated book value.
So relying only on book value can be really misleading the learner.
Especially for businesses with strong brands, competitive advantages, things accounting doesn't capture well.
And there's a key principle about retaining earnings, right?
Yeah.
Only keep the profits
If you can reasonably expect to generate at least $1 of market value for every dollar you keep and reinvest in the business.
That sounds like a high bar.
Yeah,
Very shareholder focused.
it is. The logic is if the company can't earn a good return on that reinvested dollar, shareholders would be better off getting it as a dividend and investing it themselves.
But managers sometimes hold on to earnings for other reasons.
The letters mention that, yeah. Sometimes it's about building a bigger empire or just feeling comfortable with a huge cash pile, even if it's not the best use of capital for the owners.
So management's skill in allocating that capital is crucial for building long-term value.
Absolutely critical. It's one of the most important jobs of a CEO.
And acquisitions get a somewhat cautious treatment in the letters.
Yeah, there's a healthy skepticism. They often note that acquisitions tend to benefit the seller's shareholders and maybe the acquiring management,
But not always the acquiring company's shareholders.
right. If you overpay or the integration goes badly or it's just a bad strategic fit, it can actually destroy wealth for the acquirer's owners. Ego can sometimes drive deals more than economics.
Okay. Now, look through earnings. What's that about?
It's presented as a more realistic measure of Berkshire's economic progress than just the standard reported net income.
How's it work?
Well, if Berkshire owns, say, 20% of Coke, their reported earnings only include the dividends they receive from Coke. But Coke is also retaining earnings, reinvesting them. Berkshire's economic wealth is increasing by its share of those retained earnings too, even if it's not cash in Berkshire's pocket yet. Look-through earnings tries to capture that reality.
Oh, so it includes Berkshire's share of the undistributed profits of its major investments. A fuller picture.
Exactly. A more complete view of the underlying economic engine.
And for valuing Berkshire itself, the letters suggest focusing on two main parts.
Yes, basically. One, the value of the investments per share, and two, the earnings per share from the operating businesses. But importantly, excluding investment gains or losses from that operating part.
Why exclude investment gains losses there?
Because they can be lumpy and volatile, driven by market fluctuations. Focusing on the operating earnings gives a clearer view of the core, recurring profitability of the businesses Berkshire actually runs day to day.
Makes sense. What about share repurchases? Buying back stock?
They're viewed positively, but only under very strict conditions.
Which are?
One, the company has to have plenty of cash, more than it needs for operations and good opportunities. Two, the stock must be trading below a conservative estimate of its intrinsic value.
And there was a third part.
Yeah. And crucially, shareholders should have enough information to make their own reasonable estimate of that intrinsic value. It's about fairness, preventing insiders from taking advantage.
So it's not just an automatic buyback shares whenever policy. It's very disciplined.
Very. It's about using capital intelligently to genuinely benefit the remaining owners when the price is right.
The overall acquisition strategy seems simple on the surface. Buy wonderful businesses at sensible prices with great managers.
And then mostly leave them alone. Just monitor that the business stays wonderful and the management stays able and honest.
It sounds simple, but finding those businesses and having the discipline to wait for the right price, that's the hard part.
Absolutely. And the leaving them alone part is also rarer than you might think in the corporate world.
The letters also warn against just wishing for success, right? Using the old textile business as an example.
Yes, a powerful lesson. Sometimes the fundamental economics of an industry are just bad. No amount of effort or capital can turn a truly bad business into a good one.
So, better to face reality and move on.
Exactly. Don't throw good money after bad out of stubbornness or emotional attachment. Redeploy capital where it can earn better returns.
And there's that preference for owning, say, 30% of a fantastic company over 100% of a mediocre one.
Definitely. Quality trumps quantity. Partnering with exceptional businesses, even partially, is likely to build more wealth long-term than fully owning average ones.
Okay, a quick accounting point they make. Depreciation versus amortization.
Right. Depreciation, the cost of plant and equipment wearing out, is seen as a very real economic cost. You have to spend money to replace those assets eventually.
But amortization.
Amortization, especially of intangible assets like goodwill from past acquisitions, is often viewed differently. Much of it is seen as a non-real accounting charge.
Meaning it doesn't necessarily reflect a current cash outflow.
Correct. And because of accounting rules, this non-real amortization can actually decrease over time, potentially increasing reported earnings in the future, even if the underlying business performance hasn't changed.
Ah, so it's important to understand that distinction when looking at reported profits, the learner.
Crucial for getting a handle on the true cash-generating ability of a business.
We also see the rise of the Powerhouse 5 non-insurance businesses mentioned, showing diversification success.
Yeah, companies like BNSF, Berkshire Hathaway Energy, Precision Cast Parts, Lubrizol, Marmon, their contribution to overall earnings grew significantly, reducing reliance solely on insurance.
There again, that consistent emphasis on operating earnings, stripping out the volatile capital gains or losses from investments as the key performance measure.
Yes, it provides that clearer, more stable view of how the core businesses are actually performing year in, year out.
Let's talk more about that diversification. Guy Ico's story is central, obviously, including Jack Byrne's role in saving it.
Absolutely legendary turnaround, from near death to industry leader, shows the impact of great leadership on a potentially great business model.
And the Buffalo News, highlighted for its local dominance.
Yeah, high market penetration due to a real commitment to news. But the letters also acknowledged the looming threats from cable, satellite, the internet, foreshadowing the challenges ahead for newspapers.
Right. A reminder that even strong positions can be disrupted.
Yeah, definitely.
Berkshire's acquisition criteria are reiterated often. Understand the business, trust the management, prefer large deals.
Consistency is key there. They stick to their circle of competence and prioritize integrity. The large deal preference just reflects their scale. They need big investments to move the needle now.
And the Nebraska Furniture Mart story with Mrs. B Classic Berkshire.
Oh yeah. Based on a handshake, incredible entrepreneur, enduring business dominance. It embodies their philosophy of partnering with exceptional people running great businesses.
He sees candies too, quality, service, great management, simple but powerful.
Exactly. A durable brand built on getting the fundamentals right, consistently.
Then you have the big, regulated, capital-heavy businesses. Berkshire Hathaway Energy, the utility, and BNSF, the railroad.
Huge, essential parts of the U.S. economy. They require massive ongoing investment, but provide stable, albeit regulated, returns.
Mid-Americans, now BHE, move into wind energy, was highlighted as forward-thinking.
Yes, becoming a leader there. And BNSF is described as, like, the most important artery in the economy's circulatory system, vital infrastructure.
There's also Clayton Homes in manufactured housing.
Right, navigating that market, plus managing a large loan portfolio.
And NetJets, the fractional jet ownership business.
Market leader, yes, but the letters also acknowledge it often struggled with profitability due to very high operating costs. Shows not everything is an immediate home run.
The big common stock investments over the years, Amex, Coke, Wells Fargo, later Apple, Bank of America.
Iconic franchises. Long-term bets on enduring competitive advantages and strong management. Reflects that core philosophy again.
But they also stress not overpaying, right? The U.S. Air investment is mentioned as a mistake.
Candidly admitted as sloppy analysis, an unforced error, that self-awareness and willingness to admit mistakes is important. Discipline on price matters.
We also see flexibility in their strategy, buying bonds when stocks looked pricey, using convertible preferred stock sometimes.
Yeah, adapting to market conditions. The convertible preferreds offered income plus potential equity upside. Pragmatic.
And moving to 100% ownership of the utility business over time.
Shows increasing conviction in that sector and a desire for full control over its stable earnings stream.
Okay, shifting to management philosophy and shareholder focus. Sees candies again, emphasizing quality and service.
And the managers across Berkshire, their long tenure, their passion, how few leave voluntarily. That speaks volumes about the culture.
Right, a culture that values brains, passion, integrity over, say, just having an MBA. Examples like Susan Jock at Borsheims or Kathy Barron-Tamraz at Business Wire.
Exactly. Promoting from within, valuing practical skills and character.
The Shareholder Designated Contributions Program, letting owners direct some charity, is also unique.
Yeah, it reflects that partnership idea, giving owners a say.
And the huge emphasis on aligning management interests with shareholders. True partnership, not just options that might encourage short-term thinking.
Constant theme. Critiques of typical stock option plans are frequent. They want managers thinking like long-term owners.
The warnings about derivatives over the years also stand out. often proved quite prescient about systemic risks.
Yeah, a deep understanding of potential financial dangers there. Also, the critiques of mutual fund boards, suggesting more accountability to the actual fund owners.
The advice to managers: run your business like it's the only family asset for 100 years. Powerful.
Instills that long-term stewardship mindset, and the lean, efficient corporate office gets regular praise too.
Their communication philosophy: equal, timely information for all. Releasing earnings on weekends, the Saturday meeting.
Builds trust and transparency. Fairness is key.
And the focus on succession planning, ensuring the company is in good hands long after the current leaders are gone.
Critical for a company built to last, highlighting the quality of potential successors and the investment managers.
Let's touch on the annual meeting itself. It became this huge event, right? Woodstock for capitalists?
Absolutely. Grew massively. The letters even give tips on booking hotels.
And the shareholder discounts at NFM and Borsheim's, the movie, the Q&A.
Creates a real community feel. Shareholders get to interact with the businesses, ask questions directly.
Even Jaico offering quotes there. And personal bits like mentioning Gorat's Steakhouse.
Adds to the unique personal culture. Special events for international shareholders too, showing inclusivity.
Okay, finally, long-term performance and market views. The incredible growth of the Dow and Berkshire's book value over decades is staggering.
Puts things in perspective. But alongside that, constant warnings against common investor mistakes.
Like what?
Excessive trading, market timing, not diversifying, paying high fees, using leverage. All things that erode returns.
And the skepticism about market forecasters.
Yeah, basically saying nobody can reliably predict chaos. Better to focus on the business value.
They reflected on the dot-com boom too, right? Sticking to their knitting while others chased tech stocks.
Yes, avoiding the speculation, focusing on businesses they understood with lasting value. A key lesson. Speculation looks easiest right when it's most dangerous.
And the power of compounding returns over the long haul is always emphasized.
It's the engine of wealth creation, patience and consistency.
Berkshire's book value often outperformed the S&P, especially in down markets.
Yes, showing resilience. And that idea of Berkshire's unique and quite dependable corporate personality as an asset itself. Stability, rationality.
So looking at the 2024 letter and concluding thoughts, there's an acknowledgement that the huge size makes replicating past percentage gains very hard.
Right. The law of large numbers. They need elephants, massive deals just to move the needle significantly now. It's a different challenge.
But the core principles remain: operating earnings, long-term view, insurance resilience.
Absolutely. Those are constants. Plus, the focus on succession, leaving a lasting legacy, advice for future leaders. It's about ensuring the culture endures.
The letters also touch on reactions to market swings, evolving views on tech, thoughts on government intervention. Lots for the learner to dig into further.
Definitely. The recent letters offer a realistic view of the future while strongly reaffirming the foundational philosophies. A focus on endurance.
Well, the learner, we've certainly journeyed through a fascinating multi-year story today, uncovering these really enduring business principles, investment ideas.
Timeless stuff, really.
Yeah, you've seen how focusing on value, on great management, taking that long-term view, how it helps navigate all sorts of economic weather.
Hopefully it sparks some insights.
We really hope so. Hope this deep dive gave you valuable knowledge, maybe some of those aha moments, and, makes you want to explore these ideas more.
Thinking about how they might apply to your own situation.
Exactly. How do these principles fit with your understanding of business, of investing? What stood out most? What questions are still buzzing around?
It's a continuous learning process, isn't it?
Totally. Consider this just the start of a really rewarding journey.